Welcome back, everyone. Today's explainer is diving deep into one of the most powerful yet, let's be honest, frequently misunderstood tools in our trading arsenal, Trendlines. Our goal today is clear. We're putting together a definitive step-by-step guide on how to draw accurate trend lines and spot those high-probability trade setups. We are taking the guesswork totally out of the equation so you stop getting trapped by those nasty false breakouts. Alright, let's look at our roadmap. We're covering the concept of trend lines, a step-by-step drawing guide, principles for connecting points, the bounce trading strategy, and finally, trend breakout trading. Let's get right into it. Section 1. The concept of trend lines. Before we start drawing lines all over the place, we have to break down how price actually moves. As you know, it's never just a perfectly straight line. It moves in distinct waves. To read these waves, you need to firmly grasp two core concepts: the swing high and the swing low. A market run always comes with a pullback, right? The absolute lowest point before a pullback ends and the next run begins, that's your swing low. Conversely, the extreme peak before the next move down starts is your swing high. A trend line simply connects these peaks and valleys, but it is absolutely crucial that you look at the market through the lens of these distinct runs and pullbacks. This comparison beautifully illustrates what these lines actually do. In a downtrend, we're connecting those lower swing highs. This acts as dynamic resistance. Think of it like a descending ceiling that just keeps pushing the price down. On the flip side, in an uptrend, we connect higher swing lows. Now, it's acting as dynamic support, creating a rising floor that catches the price and bounces it higher. Moving on to Section 2, our step-by-step drawing guide. Now that we're clear on what these dynamic levels are, let's tackle the main event. Exactly how to draw them perfectly on your charts without second-guessing yourself. And this brings us to the ultimate question, the one that trips up so many retail traders. When we're drawing these lines, do we connect the thin little wicks, or do we cut through the solid bodies of the candles? If you've ever stared at a chart wondering where exactly the line belongs, you are definitely not alone. While the key takeaway from our source material boils down to this golden rule, always draw your trend line where you can get the most touches. Don't overthink the exact anatomy of the candlestick. Your line might graze the tip of a wick at one point and then slice right through a candle body at another. As long as it's passing through the points that give you the absolute max minimum number of valid connections, you're doing it right. Remember, a trend line is a tool to guide your analysis, not a rigid mathematical law. Section 3. Principles of connecting points. To make sure you don't go off track, we need to list out the most critical principles for connecting these swing points. These are literally your survival rules for keeping your charts clean and accurate. First up, the absolute bare minimum number of touches you need to draw a valid trend line is 2. Anything less than 2, and you're just drawing a magic lines. Naturally, the more touches a line has, the more traders are watching that specific level. But a quick heads up, just because a line has 5 touches doesn't magically guarantee it won't break on the 6th. Treat this list as your ultimate cheat sheet. First, start treating trend lines as flexible zones, not exact concrete walls. Second, markets are messy. You have to expect brief fakeouts, where the price pierces the line just a bit before snapping back. And finally, and this is the big one, never force a trend line. If the price action is a total mess and you find yourself contorting your view just to make a straight line fit, your analysis is probably off. If it doesn't fit naturally, just ditch it. Section 4, the bounce trading strategy. What's super interesting here is how we can put these drawing principles into action by combining trend lines with pure price action. Listen, we never want to trade blindly just because price tops a random diagonal line. Instead, we hunt for what's called a high confluence zone. This is a specific area where your perfectly drawn trend line intersects directly with a horizontal support or resistance level that was previously broken. When these diagonal and horizontal levels cross paths, it creates a massive hotspot. Trend traders, support and resistance traders, and price action traders are all eyeing this exact same zone. To actually trade this zone, you need to follow these chronological steps religiously. Step 1. Identify that high confluence zone. Step 2. Wait for a strong price reaction right at that level, like a massive engulfing candle or a long-tailed pin bar. And Step 3. This is the secret sauce. Draw a short-term trend line over the pullback itself and wait for it to break. Waiting for this final confirmation saves you from those liquidity sweeps that constantly wreck amateur traders. It basically guarantees the larger trend is actually waking back up before you risk a dime. Finally, Section 5, Trend Breakout Trading. Let's see how all of this builds into trading an actual full-blown market reversal. where we capitalize on the exact moment an old trend dies and a new wave begins. But how do you know if a breakout is the real deal or a fake out? You have to look for the warning signs of a reversal before the break even happens. Watch closely when price fails to make a new high or a new low. That's a huge red flag that momentum is dying. Look for double tops or double bottoms forming. And most importantly, keep an eye out for obvious liquidity sweeps, where price briefly pokes past a key level just to trap retail traders before violently reversing. These clues tell you that smart money is taking the wheel. I literally cannot emphasize this next point enough. A trend line break alone is not enough to enter a trade. So many traders jump in the second a line is crossed only to get slammed by a fake out that triggers their stop loss. You absolutely must wait for extra structural confirmation. Things like the break of an order block or a massive engulfing candle that closes decisively. The final piece of the puzzle is multi-timeframe analysis. And this table lays it out perfectly. If you're scalping on the 5-minute chart, your higher time frame for confirmation has to be the 1 hour. If you're day trading on the 1 hour, you need to be checking the daily chart. A trend line break on your execution time frame absolutely must be supported by the broader structural context from a higher time frame. The highest probability trades always have this multi-time frame alignment. So, we've covered the whole system from defining swing points and drawing lines that maximize touches without forcing them to stacking layers of confluence and filtering out the noise with multi-time frame analysis. The question is, are you ready to apply these disciplined rules to your own charts and finally stop forcing trades that just aren't there? Bring these principles into your daily analysis and let the high probability setups come to you. So, will your next trade be a true breakout or just another trap? The choice comes down to your discipline.